I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. How's it going, everyone? Welcome back to the show. Today, we've got the co-founder of Jake and Gino, the better half of Jake and Gino. Shots fired. Gino Barbaro, welcome. $350 million of acquired value. More than that, he has helped a lot of people buy a lot of real estate. Y'all know him. He has a great podcast. He also wrote Wheelbarrow Profits, which was a freaking mic drop. The Honeybee as well. Check that stuff out. He's a rock star. Gino, welcome to the program.
I just want to let everyone know that you better buckle up for the next 30 to 45 minutes because you've got two caffeinated, hyped up, excited real estate investors on the show with you right now.
We had to stop and start several recordings because I kept switching topics, trying to make you say amazing stuff before the recording. And I just said, I'm just going to start. So here we are. One of the last things you just said was that you think we got an extra 15%. And of course, that's market dependent, but tell me more, man. Tell me more. 15% drop in real estate prices. And what's that going to mean for current buyers?
Well, Hunter, let's start out with the fact that we live in an amazing time. It's great to be alive right now. If you're an investor, especially in real estate, over the last 2 to 3 years, people are buying stabilized deals on bridge debt. You're scratching your head going, how does this make sense? I'm scratching my head going, how does this make sense? We sort of sat out. And we're pencils down and we're talking to brokers and the brokers are saying to us, you got to slam in a deal. You got to go above ask. And we're like, we can't. These numbers don't make sense. And it's so frustrating to being a deal junkie and you raising over 100 million bucks for us having over 1,800 units doing an average of 2 to 3 deals a year. It is so difficult, but everyone needs to write this down. No deal is better than a bad deal. And that's the God's honest truth. If you can stay away from those bad deals, if you look over your career in the next 10 years and you do 3 deals in 1 year, and the next 2 years, you don't do any, but then 2 years after that, you do a couple more deals, it all evens itself out, but you do not want to get into bad deals. And why am I saying 15 to 20% drop? Independent in certain markets where you have a lot of supply coming online. For instance, in Atlanta, one of our real estate coaches was having a meetup there. He only had 10 people in the audience, because that's where multifamily is right now. It's like a disease. If you're in crypto, crypto is the hot chick right now. Multifamily, no one wants multifamily right now, which is good for Hunter and Gino because there's less demand for the asset. There's less people going out there and bidding on these assets. But in that, there was an appraiser, and at the end of his meetup, the appraiser comes up to him and says, listen, these assets aren't trading in Atlanta right now. And the fear is if they do start trading, they're going to be marked down another 15 to 20% because they just don't make sense. They're underwriting for what they were supposed to get, and where rents are right now, we're in trouble. So once the dominoes start to fall, and Hunter, you know this, once dominoes start to fall, they fall so damn fast. You look up and it's like, holy crap. So if you're motivated right now and you need to sell, it may be a little more challenging. You can always buy real estate. You can't always sell real estate. And this may be one of those times where it may be a little bit more difficult to sell real estate.
Yeah, it's interesting, man. And obviously there's distress in the market, but there hasn't been the amount of volume of distress that we anticipated.
That's why.
So that means someone out there is kicking the can down the road. And
yes,
you might be right, where if prices move 20% to the downside, what is going to, let me ask a follow-up question regarding that.
Sure.
Is it that if they move to the downside like that, that at that point, some of these banks and let's say some of these borrowers are going to say, screw it, at this point, we got to cut our losses? Is that kind of what you're foreseeing?
And I think that is, but I also think the LP equity gets wiped out. I think back in 2008, I think banks took the brunt of it. I think right now in this part of the cycle, I think banks were a little bit smarter, 65, 70% loan to value. So they've got a little bit of a cushion. Although they may take a little bit of a loss as well. And I think they're just holding off banks as quickly as possible. They don't want non-performing assets on their balance sheet, and they don't want foreclosures. That's what they don't want. So they're holding off. And I think the conventional wisdom was a year ago that rates were going to drop. But we still have inflation. Stop spending the damn money, the U.S. government. You want inflation under control. Nobody's talking about this. I think I'm the only one who said this. When you have your deficit and you're running deficits every year and you continue to print money, sucking money out, taxing more, that causes inflation. If Vivek and Elon can come in and say, let's at least cut things out. It happened in Argentina. They've balanced the budget for the first time in 123 years. They cut out a lot of the federal bureaucracy there, all the different agencies there. Their inflation went from 25% down to 7% in the first year of that president's term. Can you imagine if we do that? If we're able to, let's say, just say euphoria, we balance the budget next year. What ends up happening is all that money that was going to the government goes back into the private sector. We don't have all the printing of the money. We become more efficient, and all of a sudden people keep more of their own money. I mean, can you imagine the boom that would happen? Now, it's really hard, and you need some political will because you got 4 million federal employees where 96% of them are staying home. They're not even working 40 hours a week. So that's got to be rectified some way or the other. Either show up or go find another job. But I'm so hopeful in the next couple of years of what they've assembled. People who are really smart, people who are not beholden to the system. They don't need to be reelected, right? That's what we had right now. We have unelected bureaucrats running the system, whether it's the CDC, the NIH, the World Health Organization, whatever it is. They're unelected and they're making laws. They shouldn't be doing that. So I'm hopeful that we got guys who come in who have real pedigree, like Elon, like Vivek, like RFK, these guys who have devoted their lives to what their craft is and how amazing they are. Hopefully, they have the love for the country that they've been demonstrating and talking about, that they can step in and really help us out with a lot of the problems that we're faced.
There's something to that. There's been some appointments. I'll put it this way. There's been some good appointments, right?
Mm-hmm.
And so like, when was the last time you were able to really say that? Like, it's, at least for me, I mean, you don't hear me saying that ever. So the fact that there's been some is like, that's not even a percentage increase. It's like a 0 to something increase. You know what I'm saying?
Well, Hunter, the funny thing is when you hear them complaining about appointments, whether it's Cash Patel at the whoever it is, whether it's RFK, and they're really complaining, and you're talking about like the mainstream media, not the podcasters of the world, the alternate media, the regular media. When you hear them complaining, that's when you should perk up and say, well, why are they complaining? What's going on? And then you start digging a little bit deeper. It's like, oh, it doesn't fit their narrative. It doesn't fit the status quo. It doesn't fit the advertisers. Then you start taking a roll down to there. And we had talked about that before you hit record. Go on. There's so much alternate media that you can be watching, whether it's on X, whether it's on Instagram, whether it's on YouTube. There's so much information out there. Just go out and educate yourself. Get both sides. And then you're smart enough, if you're listening to the show, that you can make at least an informed decision and say, well, not really happy about that one, not really happy about this one, but you can at least make a decision. But ultimately, for me, I think the next 2 to 3 years is going to be exciting. There's going to be a lot of opportunity, but you got to stay locked in, and there's going to be bumpy roads ahead. There have been for the last 4 or 5 years. We've had ups and downs, shutdowns, and we've had a lot of inflation, and it's been crazy. But that's when the opportunity starts to pop itself up.
Let's talk about inflation real quick. So I saw this on LinkedIn. My partner, Tyler Lyons, sent me a message, and I wanted to quote here. So quote, and this is from James Bianco, shoot him a follow on LinkedIn. An astonishing passage from Powell. Here's the quote. You had 2 months of higher inflation, September and October. As I mentioned, November is back on track. But once again, the year-end projections for inflation, it's kind of fallen apart as we've approached year end. But then he suggested, that's end quote, but then he suggested there's going to be 2 more cuts towards 2025 or in 2025. So it's kind of odd. The signal is, hey, the inflation data is trending higher than we anticipated, but we're still going to be cutting rates. What are your thoughts on that?
Well, inflation, the definition is an increase in the supply of money.
Facts.
What happens when we have inflation is we typically have higher prices. Now, this is coming from the criminal cartel that said that inflation was transitory 3 years ago. So we need to go back into history and say, what all caused this? 3 years ago, they were saying inflation was transitory because, in my opinion, they didn't want to lose the 2022 midterms. So they were playing the short game. So they held off by raising rates slower because they didn't want to slow the economy down, because we have a market cycle in real estate, but it's also an interest rate cycle. As interest rates increase, we want to slow down the economy. We want to slow down the rate of inflation and slow down the rate of prices. So they waited. And what happened when they waited? holy crap, it's not transitory. You've got to be an idiot to think it was, because lumber prices were going crazy. Used car prices were going crazy. Supply chain was nuts. It was not transitory. So they waited, and they waited too long. And then they did what, 9 increases in history. It was like one of the quickest in history. So you shock the system. All the business owners don't know what to do. There's a ton of uncertainty. And then you have the people who are really smart telling you that it's transitory, and you're saying, huh? And now you have all this data. What do you believe? We had 1 million jobs created back in March, and then that disappeared? That they keep resetting the numbers? So to me, just it's a feeling. You have a feeling when you've been in business and when you've been around for the last 30 years making payroll. Inflation is not going to go away until you cut this stupid spending. We have to rein in the spending. And if that's not going to happen, inflation for me, unfortunately, it's a great thing. I have a hard asset. I own multifamily. I own real estate. So when prices go up, what ends up happening long term? Rents go up. And it's ironic. The irony to me is Democrats, they want, they want low interest rates, right? Because the crazy part is the low interest rates create full employment, and that's what they want. But at the same time, when you have low interest rates, you have a booming economy, and a booming economy supports asset prices. So Republicans love that, or the rhinos, because they own hard assets. So it's just a dichotomy, and you're creating this wealth gap that's becoming even more and more pronounced with the policies that they've been acting over the last 4, 5, 6, 10 years. So for me, I think they're going to have to keep interest rates high because inflation is here. And unless they do cut the spending and get that under control, I mean, you saw what happened with the 10-year. It shot up. It doesn't make any sense. If you think interest rates are dropping, why is the 10-year going up? And Hunter, one last thing. If and when rates do go down, and little peons like Jake and Gino, we've got $10 to $15 million of equity trapped into our properties that we're going to refinance. So when that happens, there's going to be a refinance boom going on, and there are going to be people on the sidelines that have been sitting there to actually want to do deals. Sellers are going to have their deals work better because it's not working at 6%. But when rates are at 4%, well, that deal can make sense when you can make a little bit more money. So just be prepared. Get ready now, because when rates do drop, I think there will be a boom. I think there will be a rush to these alternative assets, and I'm getting prepared for it.
You said a lot of things there. I want to go back to one thing in particular.
Sure.
So as the recording of this, and I'll try to put this out as quickly as possible because we're at December 19 right now, and in a couple months things could change. So I'll try to get this out as soon as possible. But for the time being, what I'm talking about is that the Fed just reduced rates by 25 basis points. And when I say the Fed reduced rates, that's the federal funds rate, also known as the overnight rate. This is basically the rate at which banks lend to each other, which are part of the Federal Reserve system, Federal Reserve banks. Okay. Some people think of it as kind of the underlying metric for all other, it's not necessarily true, but it's an important metric, right? But real estate is not traded based on the federal funds rate. A lot of agency debt is based on the 10-year treasury. And so these things over a long time period will move similar to lockstep, but it isn't like the Fed reduces rates by 25 bips and the treasury goes down. In fact, we saw the opposite. The Fed recently reduced rates by 25 bips, and now we're up by 30 bips, meaning the delta between the two just increased to like 55 more bips. My question for you is, why do you think that's happening? Why do you think the treasury went up when the Fed announced that they're actually reducing rates?
It's a great question. I think there's uncertainty in the market. I still think that there's that inflation aspect that people are afraid. And I think that we are in a recession. So that's what ends up happening. I think we're still in a recession. And when there's uncertainty, you see that happening. But when you let's pull it back. When it drops, it should be better for community banks because community banks are lending at that lower rate, but their rates haven't dropped yet either, which is interesting to me because I'm talking to Jake right now because we're looking to refi a couple of deals in our community bank and bring it back to the community bank. And their rates have not dropped. Credit unions are a lot more affordable. Their terms are a lot better. They're not banks, but still their rates are a lot more competitive. And I'm like, when are community banks going to drop? Because when you drop the Fed funds rate, they're borrowing money cheaper. I mean, when the Fed funds was up there, community banks were like 7.75%, 8% 6 months ago. They were unaffordable, unattractive, and they had to give up 4% on their savings accounts. Now that's dropped to 2%. So community banks really like it when rates drop because they profit a lot more when that happens. So I'm waiting for community banks to drop their rates as well, and they haven't yet.
Okay. So just going back, because this is a question I've gotten a lot. Given that there's concerns about inflation, some people are concerned about inflation, some people aren't, right? If you own assets which increase with inflation, you're not as concerned about inflation. So what ends up happening is that when people are anticipating there's going to be more inflation, what they end up doing is they want to get into assets which will increase with inflation. So there's this significant move out of bonds and into
Yes.
things like stocks. And when people move away from bonds, the treasury yields go up. That's what people say when they say the interest rates are gone up. It's the bond yields. And so it's weird because that's why you'd see something like that. That's why you'd see that delta happen. On the other side of things, if people get really, really, really scared and they think there's going to be deflation, which is usually very short but can be very pronounced, people would sell stocks and buy bonds as like a safety thing. And when they do that, they bring bonds down, 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 down. So look, there's a complicated conversation to be had here, but that's generally how it works. And we're kind of seeing it play out right now because of the fear and uncertainty, but the fear and uncertainty is around inflation. And I think as a real estate investor, one thing you should be thinking about and concerned about is this issue of stagflation. And that's what I want to talk to you about. What are your thoughts on that? Do you anticipate that that's the direction that's going to go?
Hunter, this is a tough question also because you're looking at it from a macro perspective, and then you have to look at it from a market perspective because there's inflation. So when there's inflation and increase in prices, you would think that rents would go up. But they're actually not going up in a lot of the markets because of a short-term phenomenon where you have a lot of deliveries, right? All of a sudden, but it's really crazy because now the supply is going up in markets like Atlanta, like Charlotte, like your market of Phoenix. And it's great. Nashville. Short-term rents have flattened. Here in Jacksonville, rents have dropped 10 to 15% because there's such an oversupply in the short run. So what's going on? It's happening right now. For the longer term, once we get the catch up, and we're fortunate because all these markets that I've mentioned, whether it's Dallas, Phoenix, you have Austin, you have Charlotte, you have Atlanta, you have Jacksonville. These are all pro-growth, pro-population markets that in the long run, they're healthy. The demographics are really good for them. But in the short term, there's going to be a little bit of pain. There's going to be some concessions going on. So although you're saying, hey, prices should be going up, they're not going up in those markets because of the market dynamics. So be really locked into what's going on in your market. But I think end of 2025, when all of a sudden that supply has been absorbed, and there's really not that many startups. There's a lot less startups going on. And it takes a long time to go from permitting to the process. So I think you're going to see 26 and 27. There's going to be a shortage of new housing coming on. Everyone's flipping out right now saying, oh, there's a lot of stuff coming online. And I see all this building. That's going to work itself out. Don't worry about it. It will work itself out. And you're going to be like, oh, okay. And you're seeing it go on a lot of these markets. These builders are having problems leasing up. And there's the opportunity, these newer assets where it's like, wow, builders are there. They were projecting $1,800 in rents. They're only getting $1,600. They can't lease this thing up. They've got to sell because they've got a liquidity problem because they can't go out and fund more money. So they've got it. So if you're out there and you're in one of those markets, start looking for some of those newer assets.
Let's talk about it. What has been your typical bread and butter and how are you transitioning because of what you're talking about?
Hunter, I was like you. When you were on our podcast, you were discussing your journey, your transition. Jake and I started with value add, for lack of better words, crappy assets back in 2013. That's what you typically start out with when you're a newer investor. All you're worrying about is, I want to get a high cap. I want to make 10% cash on cash return. I don't care where it is. And you don't know any better. Fortunately,
16 flights to get to your asset. You're flying through 3 airports.
Yeah, but you don't care because you know what? That property is going to make you a ton of money, and that's all you're worried about. But the interesting thing is we were very fortunate because we hit it in the right part of the market cycle back in 13 when they were trading at 10, 11 caps, and you could add a ton of value. Now, you tack that on where the market cycle is going up. Cap rates are compressing. So I'm buying a 10 cap. 3 years later, the market's pricing it at an 8 cap. Even if I didn't do anything, I made money at that point. And that's what's been happening. So we've transitioned from older assets in that part of the market cycle to now where our assets, our vintages are newer. We're still in the same market, but we like newer assets. We're not looking so much for the heavy value adds, although we like to take 1 or 2 of those a year where we're vertically integrated. So if we've got to turn 150 units internally, it's our team. We can't buy a lot of those a year because then all of a sudden our CapEx teams are there. We can't neglect the other 1,800 units that we have. So we're very selective about buying a heavy value add where you're adding a ton of value. You're able to refi that out. And we bought a couple of assets in the last 3 or 4 months. That one was a 2018 build. One was a 2019 build. They were both from builders. And the amazing thing is they are built beautifully. We're not even used to this type of vintage, to be completely honest with you, but they were under market by $300. So you go in there, it's a light turn, maybe some retaining walls, a little bit of power washing, but it's like, holy crap, what a nice asset this is. Is this going to make me the wealthiest person on the planet? No. But what it does is it relaxes my CapEx team. I'm able to buy this asset for the next 10 years. I'm not worried about roofs. I'm not worried about driveways. I'm
Yeah.
not worried about
Boiler chiller.
HVACs. Yes, I'm not worried about turning this asset, turning this unit and spending 10K a door. This thing is going to print. And guess what? The property managers love to manage this type of asset because the median income on this thing is close to, $100,000 because they're sort of like build to rent model style. So you have that transition of when you're first starting out. And I think you should. I think you should work and cut your teeth on those older assets because you're going to make a lot more money. You're going to learn a lot about the business. But as you start transitioning and depending on where you're in the market cycle, you're going to go from older assets to newer assets, to more stable assets, to more what we call momentum plays. And there's nothing wrong with that.
Cool. What do the cap rates look like on these types of deals in today's climate for what
I
you're looking at?
mean, I think if you're in Tennessee, 5 caps, if you're buying a 1970s vintage asset in Dallas or in Knoxville, I'm sorry, they've got to be 8 caps on actuals all day long right now. That's just the reality. If you told me that a year and a half or 2 years ago, people would have laughed at you. They would say, "What? A 4 cap in Dallas on a 1970s asset is what we call a foreclosure right now." I'm sorry. It's just you're getting debt at 6% and you're getting 2 points below your debt. Unless you are a wizard and you're able to turn that property into a 9 or 10 cap and then sell it. But I don't think there's that much meat on the bone on these assets right now. So just be very careful when you're buying older assets. And those are the assets right now, ironically enough, that you're going to see on the market. Those are the assets that people need to sell because those are the assets that they overpaid. They bought them on bridge debt because it didn't make any sense. They couldn't get debt on them. So that's the opportunities. And those are the ones that are going to get the 20 to 30% haircut.
Yeah. What about the refinance? You mentioned you're going through a refinance now. On those deals that you're able to do that, like in those heavy value add deals, are you not using short-term debt because of the kind of asset product type it is? Like, tell me more about that. Because obviously, if you pay off a loan early, that's a fixed rate long-term debt. There's usually a big fee associated with that, which is okay if you want to do that. It's just I want to understand your strategy. And by the way, I paid a lot of those fees, by the way. So
it's worth paying it. So what Jake and I do is we buy stuff on community banks. We'll buy them on community banks or credit unions. So it's recourse debt. So we'll buy that on the front end and we'll get 5-year terms on those. And a lot of our banks, one of our banks has got a 2-year prepay. So it's 3% year one, 2% year two. Then after the second year, it goes away. And if you refi back to them, they won't charge you a prepayment penalty. So every deal is completely specific to the deal. The credit union, that deal, we've got to two deals with the credit unions. Those 2 deals, I don't think we're going to refi those. We've got 5-year terms on those. At the end of 5 years, we either sell the asset, we're not going to sell, or we'll just refi back to them. Or at that point, we'll just bring it to Fannie or Freddie. We'll refi to them. We may not cash out anything on that, but we'll get a 30-year AM. We'll get the IO reset. We'll get it off to non-recourse. So it really depends upon what you're trying to accomplish. But we like to look at community banks and credit unions as our bridge. And it gives us a little bit longer of a roadway. It gives us a 5-year bridge to get from point A to point B. And it takes away that risk. Now, it's recourse. But at the same time,
talk about it.
Yeah, Jake and I, we've had a lot of recourse debt in our lives, and we're buying these assets at such good prices that, hey, you know what? We're willing to take that gamble.
Okay, let's talk about this because this is you can hopefully hear the nuances of this conversation. All of it has to do with debt for the listeners. It always does. Yes. It recently came up that, oh my gosh, now all of a sudden everyone's obsessed with interest rates. But as much as I could, I was always talking about it's not necessarily interest rates. It was recently, but the story for the last 4 decades, that had nothing to do with it. Every story, though, has to do with debt. The debt comes due too soon. The interest rate expires. The IO period changes. Your lender doesn't understand the product type. If you're in some unique product type, it's always about debt. Because think about it. If every real estate deal was done in cash, you would not hear that story about your uncle losing money.
Yes.
If you just wait. So now you got this cool term. You got a 5-year term, but a step down, which is a pretty significant deal, meaning that you can implement a good business plan. But you just mentioned the recourse word. And so I'll put it this way. I've done it, and we have a loan that I am a recourse lender on. And there's definitely been some times where I've lost sleep over it. And probably because I had great mentors and they always told me like, don't do this, don't do that, don't do the personal guarantee thing, don't do the recourse thing. And it got to a point where that was pretty much the only option that worked for the business plan. And so I did it.
Yes.
And I want to hear, you probably had similar mentors to me, but it's worth it for you and your business model. I'd like to hear more about that.
It's a challenging thing. When we started out, I didn't have that much to lose, to be completely honest with you. I mean, you're buying a deal for $1 million. You're personally guaranteeing it. You're not going to lose all $1 million on that deal. Let's say you end up selling it for 900. So if there's two partners, you're on the hook for $50,000 each. I mean, business is all about taking risk. So for me, it was an appropriate risk. I didn't have that much to lose. I was buying a deal at a great basis. And that's how we evaluate every single deal. I mean, I'll give you an idea of all the last 3 deals we've done as far as price points. The 62 unit, we paid $120,000 a unit on average. The thing is renting a $1,300 unit on average. So that thing, I mean, put recourse debt on that. The one we just closed, a $12.2 million deal for 62 units, that's $145,000 a door. But that thing is a 2019 build, and rents are averaging $1,700 there. So I'm going to do recourse on that. That thing is a no-brainer for me. We're not going to lose an asset like that. I need to take that risk. And if I don't take that risk, I'm not going to do the deal. And I'm saying to myself, let's stabilize it. In the next 12 months, when it's stabilized, if rates do go down, that deal has the potential to go to Fannie within 18 months. We'll take it off. I think you need to weigh the pros and the cons, and there's pros and cons to every single situation. There's 2 quotes that I like to share with the audience. The first one is debt is the circulatory engine of the economy. When debt pulls back, like it's doing, things slow down. You can't finance a deal. And you can see when rates drop, we had rate drops probably, what was it, about 6 or 8 months ago? All of a sudden, our guys at Capital One were like, dude, man, we got a lot of deal volume going on because it's really interest rate sensitive. So I think debt is the circulatory engine of the economy. And I forgot what the other one was, but our third pillar is finance, right? And we want long-term fixed rate financing. We don't want that interest rate risk. And it comes back to, you can always buy real estate. You can't always sell it. And what that means is right now, 08, 09, you could have had a cash flowing asset. If that debt comes due and you're underwater with the value, even though it's still cash flowing, you have the potential and the probability of losing a deal like that. That's why it's important to understand timing and debt and exit strategy. What are you looking to do with this deal? How long do you need for this deal to go? And is it liable? I mean, when you're talking about guys who are taking out short-term debt 2 years ago and they had 24, 36 months to implement their business plan, and we had shortage of materials, we had shortage of labor, they had no experience doing the deals.
Yeah.
And then all of a sudden, who knew rates? It was just not a great business plan to begin with. And you put yourself under the gun and you have a time constraint, that puts a lot of pressure. And I think, to me, that's more risk in the business plan than taking recourse debt, is taking short-term debt when you don't know what you're doing.
Yeah, man, I hear you. I totally hear you. And it's just a matter of being like playing the game how you want to play it, right? And so like one of the things that you've touched on, and I've talked about it before, is that as an owner operator, look, if you're taking recourse debt, like that's on you. That's not on your LPs, right? That's one thing. Another thing is that when you take long-term debt that has these prepayment penalties, I've never heard of an LP investor reaching out and being like, oh, you did a 2.8x in 3 years and was supposed to be a 2x in 5 years. I'm complaining about the early prepayment penalty. No, they're like, dude, when's your next deal? Like, so it's like, think about it from an owner operator perspective. If you can make deals pencil with fixed rate long-term debt, you should freaking go for it. Like you owe it to your investors to set the expectation that the money's going to be tied up for 5 years, and maybe the returns aren't going to be high enough. And maybe you're going to be jealous in year 2 and year 3 because your competitors are printing money hand over fist. And like, look, I'm a competitive guy. Like, some of that got to me in 2021, 2022. Like, I'm not going to lie about that. We had plenty of meetings sitting around being like, how do we navigate the situation, right? But this is the game we play, my friends. Okay, let's talk more about the future. 2025 is now here. What is your vision? You mentioned the additional units coming online in 2025, but a dramatic drop off in development for 2026 and 2027. What is the kind of thing that you're going to see as a massive green light? And is there something you could see that can make you slow down, where you go either put the pencils down or let's be way more skeptical? Or, by the way, we're not buying any more new development. I don't like that play now for some reason. What would those things look like to you?
I'm going to answer that question, but you said something really profound that you just glossed over. And I think all the listeners need to really hear what you said. You said, and I love it, you may not get your money back in the next 5 years. And that's you speaking to your LP, to your passive investor, you creating a relationship, you having the right partner investing in your deals, because multifamily typically is not a 1 to 2 year get rich thing. And if you're doing it that way, it's a function of the market cycle. Back in 2018, 19, every 18 months, deals were flipping. On average, the life cycle of a multifamily deal is 5 years. You should be pitching that to your investors. And I think being upfront, being honest, and making sure that your interests align is one of the most important things as a sponsor, as an owner operator, that you should be doing with your investors. If you're telling them 2 years, there's a lot of risk in there. Hey, it could be 2, but more likely 5. Maybe you do that. But I think multifamily is a long game. And I think you need to explain that to your investors. Now, going forward in the next 12 to 24 months, we're always long-term buyers. For me, growing up, buying a home, living in a home, owning a home, I mean, it was the American dream. I mean, people are getting married younger. People are starting families younger. Demographics have changed. Tastes have changed right now. And I see the build to rent model. I mean, it's such a small percentage of what's going on in multifamily. But 10 years ago, I actually started laughing about it. One of my friends here in St. Augustine, his name is Jim Shields. They were talking about build to rent back in 2016. I'm like, that is the stupidest thing I've ever heard of in my life. Like, who even came up with that idea? Building single family homes and then renting them out. And I couldn't make sense of it. But these operators were able to build these homes at a cost of, let's say, 140 per home and rent them out for $1,600. I'm like, wow. Then I started seeing it. And I think that is the future. I think there's a lot more build to rent communities coming online because there's a lot of people who want to live in a home, want to have smart tech, want to have an EV charger, want to live in a nice community with a pool and all the amenities, but they just don't want to own a home because maybe next year they're going to live in Austin. And maybe 3 years from now, they'll be in Knoxville. So they don't want to own a home. So I think the future of that, of multifamily, there's a big component that we're looking at in the build to rent community. I'm bullish long-term. I think long-term, if you're in a good market, like you're in the Phoenix market, high growth, a lot of jobs, because it really is dependent upon population growth and job growth. We want demand for our multifamily because if demand drops, hey, I don't mind if demand drops and there's less supply and there's less population. That's just got to be reflected in the cap rates. Mm-hmm. I'm not buying shit in Cleveland for a 4 cap. I'm okay at an 8 or 9 cap because the future of that revenue is in those types of markets where you're having population and job decline. There's more risk. So your cap rates should be higher. So for me, I'm going to look more in the Southeast Conference. We like to call it the SEC. I like that part of the country. I think Dallas is it's just a weird market. It's just explosive. It's such a big market. It's just expanding. There's so many people moving. So I would say stick to a market that's a high growth market. It's price versus value. You may pay a little more in price, but the value for the long term, I think you're going to be okay because you're going to get ultimately a lot more job growth, a lot more rent growth, and there's going to be more stability in those markets.
I totally agree. All right. This has been very positive. We started out by the fact that we got a new administration coming in. It looks very bullish for investors. We'll have to see about what moves are made. Maybe depreciation will come back and all these types of things.
Oh, yes. We haven't talked about that either.
But
please.
Maybe could happen. One thing before we wrap up, kind of on the other side of things, you're only in multifamily, right? Exclusively. You got land and also multifamily.
Yes,
okay.
That's it.
And is there anything in the investment space right now that's giving you pause? Anything that you're seeing where you're like, I'm staying away from that, whether it's an asset class, an investment strategy, a loan product? Is there anything out there that you're like, that gives me concern, even though I'm not doing it, just LPs should be aware of it?
Crypto. I think Bitcoin is fascinating to me. I don't understand it. Listen, I'll tell you my portfolio, be completely transparent. I got about $50,000 in crypto. That's what the net investment is. Last week, when I was in New York, it went up, and within 2 weeks, it hit $110,000 in value. Now, if I was an investor, I would have sold out, more than doubled my money in less than 2 years. But I said to myself, I don't need the money. It's not life-changing. And I want to use this as a test case to show my kids what speculation looks like versus what investing looks like. So for me, it's one of those things that if you're going to invest, whether it's XRP, whether it's XLM, I own a little Shibu. I own also what else do I also own? I own Anchor and KR. So I own a mixture of these. And
Yeah.
for me, they're not investments. They're more speculative. If one of them hits and changes my life, great. If not, let it run. But don't be the person out there where you're going out and you're buying Bitcoin or you're in a frenzy. Because what happens in those kinds of investments where there's a lot of liquidity and you can hit a button, you're always buying high because you're on emotion. And then you're always selling low when things pull back. So just be aware of yourself. And I think you need to understand what your money persona is, what psychology, what you like to do. Multifamily is a slow moving asset. I mean, it's one of the best wealth creators. But if you need your hit and you're addicted to doing deals, maybe go into the single family space. Maybe you can flip some homes and keep your attention there because you're going to get bored in multifamily. I feel like you, Hunter, bro. For a couple of years, Jake and I were doing 12 units, 16 units. It was painful, but we knew, and I had made mistakes in the last market cycle of trying to veer away from what I knew best. We
Yeah.
almost got into the RV space.
Yeah.
Thankfully, we didn't do that. So just be aware. Find the niche you really like. And what gives me pause is all this debt that's coming due in the office space. I think
Yes.
I'm just worried about RV parks because were they a fad? I mean, was it cool to buy a $300,000 RV, drive around? And now that you've done it once or twice, it's like, bro, I'm not paying $600 to fill this thing up and go on a vacation where I'm going to sleep basically in a van. I don't know if that is going to change.
The industry tripled in a year, but it was illegal to travel in that year. So like
Yes,
now what? So we'll have to
yes.
see.
Yes. And even your self-storage. I mean, self-storage cap rates have come down considerably. Mobile
Yeah.
home parks. I'm not a big mobile home park person. They're tearing them down. I don't like the demographics. I don't like the resident base. It's challenging to go out there and really manage those assets. I'm not saying it's not done, and there's a lot of people who are doing it. It's just not my cup of tea. I'd rather own an apartment complex, have a real asset, a lot more cost seg to that. So for me, I think the debt, you said what's negative, the debt looming right now. We don't know what's going to happen. And I'm just not a big fan of office or retail right now.
Yeah. Interesting. I mean, you can make tons of money. There's people that are so successful, done things I've never done and would love to
Yes.
have
Or
done
dreamed of.
in all these different things. The vehicle is not the answer, but might as well be in a good boat. And you and I both see the same
Yes.
thing.
Yes.
Okay, cool. Listen, man, I really appreciate coming on. I know you're super busy, guys, so it means a lot to me. Do me a favor, let the listeners know how they can learn more about you, your books, your show, etc.
Go to jakeandgino.com. And I'm glad this show is launching the next month. I just wrote a book called Happy Money, Happy Family, Happy Legacy. Because I think the funny thing is that when people are investing, it's really their relationship with money. It's really why are you doing it? Money is not going to make you happy. You want to earn happy money and understand how to use that happy money to create a happy family. And then ultimately, as you get older, how do you create that happy family and happy money? And how do you perpetuate it and carry it on to your legacy and pass that on to the next generation?
Cool. I'm excited about that. We'll link to that in the show notes page if it's available by the time we get out. Dude, really appreciate it. Talk soon.
Thanks, bro. Ciao.